Don't believe all the headlines you read. The business drivers behind the big tech companies are looking very strong. But volatility has crept back into some of the share prices that points to a bumpy period ahead. Apple has just capped the earnings season for big tech with very strong figures. It's not selling many more iPhones than it was a year ago, but the average selling price for those phones has risen nearly $120. That's a remarkably strong figure and much better than Wall Street was expecting. And Apple shares are now at a new record high. Amazon, Alphabet and Microsoft are also seeing very strong fundamental growth, and their share prices after this earnings season are within 5% of their records, even after a cooling off in the last few days. But volatility is back, and I think there are three main reasons. One is that the bigger they get, the greater the risk when these companies don't live up to very high growth expectations. Both Facebook and Netflix are growing at around 40%, but each of those companies saw a fifth of its share price value wiped out in the last few days after they produced some disappointing forecasts. A second reason for the volatility has been concern that the core businesses on which some of these companies are founded are starting to mature, and the new businesses they've been investing in aren't growing fast enough to take up the slack. Well, the evidence from this earnings season is very positive. Wall Street is finally coming around to the idea that Apple's services business can be a real growth engine. It's growing at more than 30% a year and is now a fifth of Apple's business. Similarly, Microsoft, Amazon and Google are seeing very strong growth from the cloud. The third reason for volatility is a real wild card: regulation. Wall Street has been trying all year to work out what risk this poses to big tech and is none the wiser. Facebook stock fell 20% in March in the midst of the Cambridge Analytica scandal. The stock bounced back 40% to a new record, and now it's plunged again on growth worries. It's a sign of just how volatile some of these shares are becoming, and the bigger they get, the harder they fall. This is Richard Waters for the Financial Times in San Francisco.